You've been told all your life that gold is the ultimate safety net, right? Everything has collapsed, and gold still exists. War has happened, and gold protects you. Inflation is out of control, and gold is your insurance policy. One thing can be shocking: gold may really be the worst way to create real generational wealth in 2026. I know, it sounds absolutely crazy. I know that if you had a boomer uncle who started buying gold coins in 2008, he might be shaking his head now. But stick to my point, because I'm going to show you 7 stocks that will outperform gold by millions of dollars. If you really invest strategically over the next decade, these are not cheap stocks. This is not a crypto gamble. We're talking about boring blue chip companies that most people ignore entirely because they sound so boring. There is no doubt that gold's performance is incredible. Prices are now close to $5,000 an ounce. But these numbers don't lie, and I'll tell you why you need to rebalance your portfolio if you increase your gold holdings. These numbers will shock you. Over the past 5 years, gold has returned about 6.5% annually, almost 4 times as much as the S&P 500. When you look at the raw data, gold has been crushing the stock market. But here, the claim is completely untenable. Gold generates zero cash flow. When you buy an ounce of gold, you're not buying a stake in a profitable company. You did not receive a dividend payment. You don't benefit from innovation or quality management. You're betting that tomorrow, someone will pay more for the same metal than today. This is the whole investment theory. Compared with stocks, you see completely different animals. Apple pays a quarterly dividend. Johnson & Johnson generates billions of free cash flows a year. Even if the stock price has risen sideways for many years, you can still hold it with money, which is compound income. This is true wealth creation. I fully understand why people like gold now. Geopolitical uncertainty is real. Central banks have been printing money as if it were out of date. Treasury bonds are now $36 trillion. These are legitimate reasons to worry about currency depreciation, and gold plays a real hedging role in the portfolio. When everything else melts, it rises. Most investors don't understand the actual math of portfolio allocation. According to a study published by WisdomTree, ordinary investors hold between 0 and 3% of their gold portfolios. Based on actual portfolio theory and actual risk management, it should hold about 12%. So you have this strange situation. Most people are either completely underweight or completely overweight, with very little middle ground. The real question is what investors are missing. Anyone who bought a lot of gold from 2020 to 2024 completely missed the stock market bull market that just happened. They optimized for the wrong situation. Now that gold prices have risen, future returns are expected to be quite moderate, taking into account storage costs, insurance premiums, and the fact that gold will never compound interest. Let me give the actual numbers. Because without data, theory is meaningless. Imagine 2016, when you have $50,000 to invest. You are a cautious investor, so you split gold equally with the S&P 500. The gold was stored there for a decade until April 2026 and is now worth about $55,000. That is 120%. Not scary? In 2016, the same $25,000 in the S&P 500 index fund is now worth about $96,000 before dividends. That is 28.4%, nearly doubled. There is no need to pick stocks or chase dividend payouts. This is the implicit cost of choosing gold over stocks. It is not that gold is bad. That is because when you let the numbers run out in a few decades, the opportunity cost of that choice is absolutely huge. Some of you may now be thinking, if we're about to fall into a market crash, shouldn't we use gold as insurance? That is a reasonable question, and I want to address it directly. JP Morgan, the world's largest investment bank, has just raised its gold price target to $6,300 at the end of 2026. BlackRock, which manages about $11 trillion in assets, remains bullish on gold. No one predicted that gold would collapse. That is not what is happening here. What is actually happening now is that most investors have completely missed this, which is a large-scale market rotation. April 2026 was cruel for some industries and surprising for others. AI stocks, dividends, infrastructure highlights, some of which have been printing money, while commodity prices are rebounding. Now is the right time to build a stock portfolio, because valuations in some areas of the market are still reasonable. The S&P 500 as a whole is expensive, but if you're really selective, if you really do the real work of identifying high-quality dividend payers and high-quality growth stocks, you can find real value. At the gold conference, no one talked about this. Every dollar sitting in a zero-rate safe didn't work. It doesn't generate revenue. It has not grown. It just sat there. One thing you don't often hear. Most people don't really need gold. They need income. They need cash flow. They need assets that compound over time. If you really want to build generational wealth, if you really want to retire comfortably and leave your children something substantial, you need to focus on stocks, not shiny metals. A small amount of 5 to 10% precious metals as insurance. That makes perfect sense. But 30%, 40%, 50%? It was a multi-million-dollar speculation, masquerading as security. Here is what I did with this data. I looked at the April 2026 data, analyzed which sectors would provide the best risk-adjusted returns over the next decade, and identified 7 specific categories of stocks that I believe will significantly outperform gold. Let me introduce the framework first, and then the specific choices, because the framework is the most important. Market changes. Stocks were mixed, but the principles behind wealth creation are timeless. Category 1. Dividend aristocrats. The companies have raised dividends for 25 consecutive years. When you see that track record, something happens. It is not flashy. It is not exciting. But what it tells you is that these companies have a lasting competitive advantage and management, and are actually rewarding shareholders, not just making money from their business. Johnson & Johnson, Procter & Gamble, Colgate-Palmolive. The companies sell soaps, razors, and pharmaceuticals. It is boring and profitable. That is why they splurge on cash like you don't believe it. The second category, Dividend King. Which level is higher? Dividends have risen for 50 consecutive years. These are really rare in the market. We may now see 56 of them in the entire system. Coca-Cola has been paying dividends for more than a century. If you hold these stocks and reinvest the dividends, the 30-year compounding effect is frankly obscene. We're talking about double, triple, even tenfold returns. The third category, supermarket value technology moat. I know this may sound paradoxical, because technology valuations are expensive now. But there is a difference between being expensive and overvalued. Microsoft, Apple, and several other companies have built an absolute moat around their business. They have pricing power. They have a network effect. They have a market. AI is accelerating their dominance. Yes, you may pay a premium for these products, but the premium is actually determined by competitive position. Category 4, AI infrastructure. I am not talking about sexy companies. I mean picks and shovels. Broadcom makes chips. Micron makes memory. Everyone is obsessed with which AI model wins the game. But what people miss is that no matter which company dominates AI, someone must make semiconductors. These scripts have incredible unit economics. Category 5, healthcare and biotechnology. That is boring for most investors, which is why it works. Population aging is real. Developed countries are aging significantly. Demand for medical services will surge in the coming decades. Companies that make medical devices, drugs, and medical software face headwinds that will last decades. Category 6. Financial services with pricing power. JP Morgan took in more deposits than they knew what to do. Interest rates are stabilizing. The net interest margin is huge. Banks actually want higher interest rates. When interest rates are high and stable, the financial sector thrives. This is not a market-dependent game at all. This is an interest rate environment game. Category 7. Defensive quality in the downside market. Basic services. Utilities. Major consumer goods. When the stock market crashed, stocks traded sideways and rebounded after the situation stabilized. They are tired of the bull market. They are the heroes of bear markets. This is the most basic combination construction. Now let me look at these specific companies, and I'll give you the stock code, the current yield, and why each is important to your portfolio. First share, Johnson & Johnson, J&J. Blue chip dividend giant. Johnson & Johnson is actually a classic example of dividend aristocracy going to extremes. Dividends have grown for 61 consecutive years. That is longer than most people actually live. The company makes pharmaceuticals, medical devices, and consumer health products, making billions of dollars a year from cancer drugs to Band-Aids. The current yield is about 2.9%. On the face of it, that may not seem like much, but here is what changed the math. J&J has historically raised its dividend by 5 to 7% a year. So your earnings today aren't just 2.9%. You get more and more money, and it gets better and better year by year. Work with me on some actual numbers. If you invest $55,000 in J&J now and reinvest all dividends within 25 years, assuming historical dividend growth continues, you are about $185,000, given their track record and free cash flow. That is 370%. Now compare this exact scenario to gold. The same $50,000 income is 0%, and you want someone to pay more for it. Gold must rise all the way to $180,000 to keep up, with no dividend income or interest of any kind. Second largest stock. Procter & Gamble, PG, inflation hedge you actually profit from. Procter & Gamble has been on par with gold and hedging inflation, but the difference between Procter & Gamble and gold is that it is actually a business. When inflation hit, Procter & Gamble raised prices for shampoo, detergent, and diapers. Revenue increased. Profit margins remained unchanged. Dividends continue to flow to shareholders. They are themselves dividend aristocrats, now rising for 67 consecutive years. The yield is about 2.1%. With the same growth, the company has recently faced some challenges in supply chain costs, but its pricing power is still intact. That is what really matters. Stock number 3, Microsoft, MSFT, AI leverage game. I know some of you think Microsoft is running out of money and valuation. Here is the thing. There is a good reason Microsoft is so expensive. They control the market value of $3 trillion because they really control the critical infrastructure that governs the world. Office 365, Azure, Copilot, none of these products work well. They are integrated into the entire global business infrastructure. Yes, the stock is gone, but what happens when all these AI investments really start to generate profits? We are still in the early stages of this round of negotiations. The company has a lot of room for profit growth in the future. While waiting for appreciation, you can also get dividends. Stock number 4, Broadcom, Avgo, Semiconductor Drama. Broadcom makes chips and infrastructure that power data centers, AI systems, and connectivity. It is a game of hose and shovels. As AI spending accelerates and is absolute, because we're talking about hundreds of billions of capital expenditures, Broadcom will benefit no matter which company wins the AI race. The company gets pricing power, recurring revenue, and big profits. Gross profit margin exceeds 6 to 5%. From an investor's perspective, that is a good thing. Stock 5, Medtronic MDT Medical Infrastructure. Medtronic is a large medical device company that makes everything from pacemakers to surgical devices. The aging of the population represents a structural headwind that will undoubtedly exist for the next 30 years. Birth rates fall, life expectancy rises, and demand for healthcare only rises. They are also dividend aristocrats, continue to generate cash flow. The stock is undervalued, which actually makes it attractive to investors. You can buy high-quality products at a reasonable price, which is rare in this market. Sixth, stock JPM Morgan Chase, JPM, interest rate environment at work. Here is a controversial argument. When interest rates are high and stable, banks are actually good investments. JP Morgan Chase is China's largest bank. They have large deposits. They have extraordinary pricing power. At present, the spread is favorable. The company's earnings per dollar of assets are higher than they were 5 years ago and are realized in a less risky business environment. Dividends are stable and repurchase plans are active. Stock number 7, Coca-Cola Cocoa Compounding Machine. This is my favorite stock to illustrate the practical role of compound interest. Coca-Cola began paying dividends in 1893. They've lived through every recession, every war, every financial crisis, every economic upheaval. For decades, the company's basic business model was the same, selling soda to as many people on Earth as possible. It is not a complicated business strategy, but it works. The dividend yield is about 3%, which has been raised for 61 consecutive years. Growth is moderate, with annual dividends of 5 to 6%, but that has become unusual for more than 3 decades. As profit margins rise, so do prices. But here is an important story. If you invested $10,000 in Coca-Cola in 1944 and let it sit there and invest in dividends, you have about $800,000 today. 80万美元 from a $10,000 investment. That is what compounding does in a business with real durability and cash flow. Gold? The same $10,000 in 1944 could be worth $50,000 today. You never get a dividend. You just sit and hope prices go up. That is the difference. I don't want to oversimplify what happens next. You can't buy all 7 stocks equally and expect to be a billionaire. Investing requires balance, discipline, and the actual strategy behind it. If you are someone between 35 and 60 who cares about inflation and is very interested in accumulating wealth, build a portfolio like this. Rule 6310 basically goes like this. 60% of your portfolio is invested in dividend growth stocks, which is your wealth accumulation engine. That is where compounding happens. What you want is a mix of dividend aristocrats and kings, a few large-cap technology stocks, and some medical exposure. Reinvest those dividends. Don't touch it for 10 years. 30% enter the diversified growth portfolio. This may be an index fund or ETF or a growth stock in the rising sector. You want some upside. You need options in case something goes wrong. But that is not your core wealth engine. 10% chose the alternative. That is where gold fits, maybe some bonds, maybe some real estate, maybe some international stocks. Diversity prevents disaster. You don't need a mountain of alternatives, but if stocks are punished, having some can prevent you from being completely exposed to risk. Does this strategy sound boring? Well, boredom is exactly what you want. Boring compounds. Boredom makes you sleep at night. Ordinary people don't need to be 10% ahead of the market. You don't need to find the next Tesla or the next Apple. You need to earn an actual return of 8–10% a year, reinvest your income, and don't panic when the market corrects. That is actually it. That is how 99% of the rich accumulate their wealth. To be honest, if you hold the 7 stocks I mentioned, reinvest in dividends and don't sell during a panic, you will almost certainly outperform most investors and beat gold at a huge profit margin. Some of you may now be thinking about the elephants in the room. What about a real currency collapse? Stagflation. War? Gold will really win, not stocks. You're not wrong. In a real financial apocalypse scenario, gold may be your best friend. If we have hyperinflation, if the dollar collapses completely, if we have a real social collapse, yes, gold may be more useful than stocks. But the honest truth is, if we do have a social collapse, all of us have bigger problems to worry about than our portfolios. The probability of this happening is very different from normal market callbacks, economic slowdowns, and cyclical recessions. The basic situation is that the U.S. economy continues to grow. The company continues to make profits, dividends continue to be paid, and stocks continue to compound interest. The basic situation is what you should actually plan for 200 years. I'm not completely blind to gold. I mean, no more. Insurance of 5 to 10% is reasonable, but 50%. This is not prudent portfolio management. It was a fear-based decision that was costly. I understand why gold feels safe. It is tangible. You can hold it. No one can print more. In a world of uncertainty, this comfort is deeply rooted. But comfort is not the same as reward. Over the next decade, 2 or 3 decades, if you want to accumulate real generational wealth, if you want to retire comfortably, take care of your family, and leave meaningful things for your children, you need to reunite. You need businesses that generate cash flow. You need dividend growth. You need to own the most valuable company in the world. The 7 stocks I covered today, Johnson & Johnson, Procter & Gamble, Microsoft, Broadcom, Medtronic, JP Morgan Chase, and Coca-Cola, won't excite you at cocktail parties. They are bad for good conversation. But if you do promise to own them for 10 years or more, they will make you rich. The numbers are clear. Dividend growth stocks outperformed gold. Quality companies outperform commodities. Compound interest trumps hope. Boredom trumps flashiness. So my challenge now is to review your portfolio. If you're overweight, honestly ask yourself if you're doing it because of rational analysis or fear. In the latter case, it may be time to rebalance. Subscribe. Tap the notification bell. Don't buy gold just because your uncle told you to. Do your own research. Calculate the numbers yourself. Math is right in front of you. You don't have to trust me.